More than $6 trillion disappeared in about an hour. If you chase the top, that sting is real. Silver went from roughly $121 to $108, and gold slid from about $5,600 to $500, fast enough to make even seasoned traders freeze. Before we go any further, smash the like button, subscribe, and turn on notifications. This channel is about clarity when the charts turn chaotic, and today's breakdown can genuinely protect you from repeating the same mistake. Now breathe. This isn't random volatility, and it isn't some mystical force either. It's a predictable chain reaction, liquidity, leverage, and one index most people never watch. Today is January 29th, 2026. Around 10:30 a.m. Eastern, metals were ripping. About 60 minutes later, the floor opened up. Gold down about $500, silver down about $13. If you had $100,000 parked in silver at the peak, you're staring at around $89,000. And if you were leveraged, margin, short-dated calls, anything that needs price to behave, you didn't just lose money, you lost control. Here's what liquidations triggering liquidations really means. Price drops, margin calls hit, forced selling kicks in, and that selling pushes price lower. Lower prices trigger more margin calls, more forced selling, and the whole thing turns into a waterfall. So the question isn't, why did metals fail? The question is, what flipped the switch? Because gold and silver didn't break on fundamentals in 1 hour. They moved because the macro lever moved, and that lever has a name, DXY. If you've never heard of DXY, pay attention. This is one of those level up moments. DXY is the US dollar index, a measure of the dollar against a basket of major currencies. Metals are priced in dollars. When the dollar strengthens, it often pushes the dollar price of metals lower. Not every tick, not in every crisis, but as a dominant relationship, this is the Seesaw Pros watch. Most retail traders stare at the gold chart and the silver chart and ignore the dollar chart. Professionals do the opposite. They track the dollar first, then decide how aggressive to be in metals. So what happened today? The dollar ripped higher, DXY spiked, and metals absorbed the impact. Fast, brutal, and in a market packed with leverage. Now let's answer the real question. Why did the dollar surge? There are 3 drivers, and you need all 3 to see the full picture. Number 1, the Fed tone and rates. When the Fed sounds hawkish, markets price in higher for longer rates and yields pull capital into dollars. Higher yields can lift DXY quickly, especially when traders are already positioned for a move. Then metals get hit twice, by the stronger dollar and by the rush to de-risk. Number 2, China and industrial demand fears. Silver isn't only a store of value, it's also an industrial input. Solar, electronics, EVs, semiconductors. When China's data hints at slower manufacturing momentum, traders haircut future demand. Silver usually reacts harder than gold because it's more volatile and more tied to growth expectations. Number 3, the shutdown headline and risk off flows. The US government funding deadline is January 31st, and markets hate uncertainty more than bad news. Even if shutdowns tend to resolve, funds reduce risk, lock profits, and raise cash. After a huge month, take profit just needs an excuse, and political noise is a classic excuse. Put those together, a dollar spike, growth jitters, and risk reduction. Now add one more accelerant almost nobody talks about, positioning and liquidity. When a market rallies hard, it builds crowded trades, late buyers, leverage, and stop-loss clusters. Once price starts falling, those stops become fuel, spreads widen, and liquidity thins out. That's how you get a 1-hour move that feels like an earthquake. It's not magic, it's mechanics. Crowding plus speed plus forced selling. Now, let's talk gold versus silver because treating them as the same trade is a rookie mistake. Silver is basically gold with turbo. When gold moves, silver often moves more, up and down. Today, gold fell roughly 9% and silver fell roughly 11%. That's the multiplier at work, and it's why silver makes people rich fast, or breaks them fast. And here's a key tell. When both metals dump together, it's usually macro. When silver dumps alone while gold stays steady, that's often industrial or silver-specific pressure. Today was macro. Today was the dollar and the risk unwind. And that matters, because it tells you what to watch before the next hit comes. Here's the part you need to lean in for. We've seen a similar structure recently, late December 2025. A sharp flush, ugly sentiment, forced selling. Then January launched. Whether your chart shows slightly different numbers, the point is the same. After the flush, the snapback was violent, and late sellers watched it happen without them. So is this the end? Or a reset before another leg up? The long-term story didn't change in 1 hour, only the mood changed. Central bank buying doesn't vanish because of one red candle. Reserve diversification doesn't reverse in 60 minutes, and industrial demand trends don't switch off overnight. What had changed today was sentiment. Weak hands got shaken out, Strong hands got a cheaper price and the market got a reset. But I'm not here to tell you buy or sell. This is not financial advice. I'm here to give you a framework so you stop being surprised and stop being exit liquidity. So let's game it out with 3 scenarios. Pick the one you think is coming because having a plan beats guessing. Number 1, the bull continues. This is a shakeout inside a larger uptrend. DXY cools off, fear fades, buyers return. If that happens, silver can retest 120. Well, we'll call it quicker than most people think. And the people who panic today will be the same ones chasing again later. Number 2, more pain first. The Fed stays tougher than markets expect. DXY keeps pressing higher, and risk stays tight. Gold could revisit the high 4,000s, and silver could probe sub $100 again. A second leg down is possible when volatility stays elevated and liquidity stays thin. Number 3, the chop zone. We go sideways and frustrate everyone. No moonshot, no collapse, just chop. That's often when retail taps out, and the next trend begins with nobody watching. Now for the on-the-record call I promised. If the risk headlines fade and the dollar spike cools, I expect silver to trade back above $120 by February 15th, 2026. Screenshot that. Hold me to it and tell me in the comments if you think I'm right or delusional. But here's the real edge. How you act matters more than my prediction. If you hold physical as long-term insurance, intraday candles shouldn't bully you. If you're using leverage, today should be your wake-up alarm. Volatile assets plus leverage is how accounts get erased even when you're right long-term. And if you're sitting on cash, scale in slowly. Don't go all in on one candle. Build a position like a professional, not like a gambler. Here's what I'm watching next, and you should too. These signals will usually tell you what comes next before the headlines do. Number 1, DXY direction. If the dollar keeps squeezing higher, metals can stay under pressure. If it rolls over, the bounce can be sharp. Number 2, the February 1st market open. The day after the deadline will show whether fear was priced in or whether stress is spreading. Number 3, China headlines. Any sign of stimulus or a rebound in manufacturing is fuel for silver. More weak data is an anchor. Number 4, Fed speakers and yields. Watch what officials say, but also watch what rates do. Words matter, yields matter more. So let me ask you, which scenario do you think plays out? Type it in the comments, bull continuation, more pain, or chop, because I read them all. If this breakdown helped, hit like so more people see it when they're panicking. Subscribe to Chill Guy for daily gold and silver context without the noise, and send this video to the friend who just bought the top and doesn't know what happened. Understanding beats thoughts and prayers every time, especially in markets built to punish the unprepared.